This In this module, we will discuss the proper reporting of bond interest expense under the effective interest amortization method. So as an overview, when we have bonds, this means we are borrowing money from several individual investors, we're issuing bonds, and we're going to pay them back at the end of the bond's maturity, but in the meantime, we still have to pay them interest expense along the way. Now, generally, if we have a par value bond, which means we issue this at par, this means that the interest expense is going to be equal to the cash interest paid. If this bond is issued at a discount or a premium, however, then that means that the interest expense will not be the same as the cash interest paid. It will be either higher or lower than that amount. In this module, we'll talk about how to calculate that new interest expense. So the issue here is that when we have a bond issued at a discount or premium, this leads to an amount that we have to amortize over time. We have to use that up, and then that will adjust interest expense. So the discount will increase interest expense above and beyond the amount of cash interest paid. The premium decreases interest expense below the amount of cash interest paid. So in this case, we're going to talk about the term carrying value. We've already covered par value, which is face value. That means that's what's stated on the face of the bond. The carrying value, if it's issued at par, the carrying value will be the same thing. However, if it's issued at a discount or premium, it's going to be a different amount altogether. The carrying value will equal the issue price of the bond initially. If it's a if it's a premium bond, then it's going to be the face value plus the unamortized premium. If it's a discount bond, then the carrying value will equal the face value less the unamortized discount. What this tells us is that the face value or the carrying value of a premium bond is going to start out above the face value. The carrying value of a discount bond is going to start out below the carrying value, the face value. So let's take a look at an example. In this case, the bond sold at $110,000, but it had a face value of $100,000. The carrying value, and this is a premium because the bond sold at a higher price, the carrying value is going to start off higher at $110,000, but eventually it will decrease over every period of interest, and eventually it will equal the face value after this premium has been amortized at the end of this bond's maturity. Now let's take a discount example. The bond is sold at $90,000, which is below the face value of $100,000. The carrying value is $90,000 initially, but it will increase over time as the discount is amortized. Again, it'll get closer and closer to the actual face value. This is just a basic example of what this might look like. These numbers don't really tie to anything in our earlier example, and in fact it's a little bit extreme because we're saying here the face value of this particular bond is somewhere right around $60,000, and here we're saying we actually issued it at $10,000 for a discount. And again, that's a very extreme example. I'm just trying to make a point that the discount starts low, works its way up to the face value over time. The premium starts high, works its way down to the face value over time as well. This is what it's going to look like on the balance sheet. You have your bonds payable in the liability section, less unamortized discount, or plus unamortized premium, and then you'll have the net carrying value of the bonds. By the time this bond reaches maturity, this carrying value will equal the bond's payable amount, and then we're going to pay it off completely. So now to really drive this home, let's take a look at the journal entries related to both a premium and a discount. In the premium example here, we're going to issue the bond at a price of $113,420, and we'll see where that amount comes from. The bonds payable here is $100,000, so the difference is a premium of $13,420. That's just the difference between the purchase price and the actual face value. Now, when we amortize that, every time we have interest entry, we're going to have to figure out how much of that premium should be amortized this period. By the way, this first entry will be the same whether it is a straight line method or the effective interest method we're using. However, the interest expense entry will change depending on which method we're using. Furthermore, under the straight line method, every year this interest expense entry will be the same. Under the effective interest method that we're using today, every year is going to be different, and we'll see why in just a little bit. But what we're going to do here, we're going to see that for the interest expense entry, notice that we originally credited the premium, which is an adjunct liability account. It adds to the value of the liability. To decrease it over time, to amortize it, we have to debit that premium. So in this case, we debit it for $926. And we'll see where this amount comes from. Now notice the cash interest is just going to be 10% of the face value. This is a 10% bond in this example. So $100,000 times $10,000 or 10% equals $10,000. Now that's the only credit we have. We have two debits that can only equal $10,000. The premium has already eaten up $926 of it, so there's only $9,074 left for the interest expense. And we will see again how that is calculated. Let's take a look at a discount. With a discount, the cash is going to be less than the face value. In this case, it's only $87,711. The bonds payable is $100,000. The debit to discount, we're going to debit it. It reduces the value of the bond, and we need to debit it so that our total debits and credits balance out. Now, when we record the interest expense entry, since we started with a debit to discount, we now have to credit the discount every period to use it up. The cash interest, in this case, it's an $8,000, I'm sorry, this was a, in this example, it was actually an 8% bond. My apologies. So it's because it's a discount, the interest rate had to be less. So this was an 8% bond multiplied by $100,000. That's where we would get the $8,000 interest. Now, we have to credit the discount, and it's going to be $771. We'll see where that comes from in a bit. So the total of our two credits gives us the amount to debit for interest expense. The interest expense under a discount bond has to be higher because we had more discount on the credit side, which requires more interest expense on the debit side. So now let's take a look at how interest expense is calculated under the effective interest method. To know that, we have three different pieces to that journal entry. First of all, the cash interest paid. This is going to be the face value of the bond multiplied by the stated interest rate on the bond. Now that's the stated rate, that's not the market rate. That's the cash interest paid. The interest expense is going to be the other interest rate, the market rate, multiplied by the carrying value at the beginning of that period. This is where the difference comes in between the straight line method and the effective interest method. The carrying value is going to reduce over time. We're multiplying it by the same rate, but the value, the balance that we multiply it by differs. It reduces or increases, depending on whether it's a premium or a discount. And we'll see that in the amortization schedules in just a bit. Now we back into the amount of discount or premium we're going to amortize. It's simply the difference between the cash interest paid and the interest expense. So this is where the difference comes in between the two methods. Under the straight line method, the premium and discount is going to be amortized equally over the bond life because that number is going to be the same every year. The interest expense will be the same. And of course, the cash is always going to be the same no matter what method you're using. Under the effective interest, we just said the premium or discount is a number we back into based on the difference between the cash interest paid and the interest expense. So that part's just a repeat of what we just looked at. Now, the best way for this to really become apparent is by looking at an amortization schedule. An amortization schedule basically walks us through, it shows how the value of the bond changes over the life and how the premium is amortized throughout. So what we have here, the beginning carrying value is $113,420. In this particular bond, it was a premium. By the way, that year zero is there just to show beginning balances. Shows the beginning balance of the unamortized premium being that $13,420. Then on year one, we have that same beginning carrying value. Notice that we have a $10,000 cash payment, which does not change throughout the life of the bond. That's a 10% stated rate multiplied by the $100,000 face value of the bond. Now, the interest expense is what's different here. This is going to be calculated by taking the $113,420 carrying value at the beginning of that period multiplied by the 8% effective rate for that period. 8%, it's $9,074. Now, we know we had $10,000 cash payment, $9,074 interest expense. The difference is $926 that is going to be premium that's amortized. Now, you can see here that our unamortized balance of the premium is $12,494. As that decreases, our bond also decreases. It starts off high, and eventually it's got to get down to $100,000 to match the face value of the bond. So notice what happens here. Our carrying value is decreasing. That leads our interest expense to decrease as well because it's the same rate multiplied by a decreasing value. So our interest expense has to decrease over time, which means that our premium amortization has to make a bigger amount. We amortize the premium more quickly toward the end. Keep in mind, these two always have to balance out to $10,000. Now let's take a look at the effective interest method when there's a discount. So in this case, we have a beginning carrying value, the same, the low amount, $87,711. It's going to work its way up until it eventually hits $100,000. We start off with a $12,289 discount, the difference between $100,000 and the $87,711 carrying value. That unamortized discount we're going to use up over time, so it eventually hits zero. Cash payment, now it's an 8% stated rate, so this is just an $8,000 cash interest payment. The interest expense is going to be the beginning carrying value multiplied by the 10% effective rate, $87.71. Now notice as this balance increases to get closer and closer to $100,000, our interest expense is going to increase as well. Now notice in this case, the discount amortization increases alongside of it because the interest expense was already above the cash interest payment, and it just gets higher and higher and higher as you get closer to the end of the bond's life. So that's a little different than what we saw with the premium. But keep in mind, under a discount, the cash payment plus the discount has to equal the interest expense. And that takes us to the end of this session for the effective interest method.